Ladies and gentlemen, today we are talking about implied volatility when it comes to trading options. This is one of the most important factors when it comes to option pricing and making a profit. You cannot make consistent profit if you don't understand this concept. So in this video, we are going to break down everything that you need to know, including how implied volatility works, how it affects your options, and what you can do to take advantage of this implied volatility in order to make some profit. But most of all, not understanding implied volatility is one of the main reasons people lose money with options. So my goal for today is for you to be able to use these concepts and apply them to your investing in order to make better decisions. Now be sure to stick around until the end because I will be laying out a practical plan of attack that ties everything together and shows you exactly how to use IV to your advantage. So give this video a like, subscribe if you haven't already, and let's get into it. Hello everybody, my name is Alex Pandrea. Now before getting into implied volatility, let's take a step back and answer the basic question of what is volatility, what it actually means in the stock market. So in simple terms, volatility just means how much and how quickly a stock price moves. So for example, a stock that quietly trades between $98 and $102 for months would be considered low volatility. A stock that jumps from $100 to $120 one week and then it crashes back down to $90 the next week, well, that would be considered high volatility. So volatility is really a measurement of uncertainty and movement. Now, it doesn't tell us whether the stock is going to go up or down. It's just how wild that stock movement is, right? How wild the ride is along the way. Now, just to put that into perspective, a stock that is up and down with wild swings like this, I mean, you can just take a look at a stock chart and see if a stock is volatile, meaning it goes up, it goes down sharply, it goes up, and you can't really predict the swings of a stock, then that would be a highly volatile stock, right? Now, on the other hand, if a stock is just moving quietly up or rather down, it doesn't matter which direction it's going, but if there are no crazy swings and it's more steady, a smoother ride, then this would be a low volatility stock, right? So you can pull up, your trading app and go to any stock, and you can pretty much determine if a stock is highly volatile or if it is not volatile at all or having low volatility. Now, there are two main types of volatility. There is historic volatility, or rather what has happened in the past, right? So this historic volatility would look backwards at price movements to determine what the historical volatility is. And there is also implied volatility. Now, implied volatility is what we're going to focus mainly on this video, and this looks forward into the future. This is the market's estimate based off of option pricing on how much movement is expected in the future. Now, when it comes to options, it is implied volatility that will determine and affect option pricing, so we are going to concentrate on that moving forward. However, a bit of historical volatility will play into this a little later on, and we're going to understand the relationship between the two, okay? So that's something very important, which a lot of people I see don't talk about, but we're going to break it all down, all right? So the main idea here is volatility in and of itself means movement, right? Big swings, high volatility, steady stock movement, low volatility, all right? All right. Okay, so now that we understand the bigger picture here, let's dive deeper, all right? What exactly is implied volatility and how does it play into trading options? So in simple terms, here's the definition of implied volatility. Implied volatility is the market's expectation of how much a stock might move in the future, expressed as a percentage over the course of 1 year. Okay, now that's really important. So IV, implied volatility, is always quoted on an annual basis, even if you're looking at options that expire in a week or in a month. Now later on, we are going to take a look at how you can actually calculate IV on a shorter time frame. But for now, just know that IV, when you see it as a percentage, that is an estimate of how much that stock will move over the next year. All right, now here's a key point if we take a look at this definition. The IV is describing the stock movement, not the option itself, not the option contract price. So when you see an IV of 30% or 50%, that is the market telling you how volatile it expects the stock to move, not the option contract, all right? So for example, if a stock has an IV of, let's say, 20%, that means that the market is pricing in the possibility that the stock could move about 20% up or down over the next year, over the next 12 months. Now, if a stock, let's say, has an IV of 100%, then the market just thinks that it can swing as much as 100% in either direction. But does that mean that the stock can then go to zero? Well, not really. It simply means that the market expects very large swings, potentially doubling to the upside or cutting in half on the downside. In other words, 100% IV reflects extreme uncertainty or extreme potential movement, not a guarantee collapse. And that word guarantee is important here, and it's something beginners often get confused about. So the IV percentage is not a guarantee. This is why we have the word implied in front of it. A 30% implied volatility doesn't mean that the stock will move 30% this year. Instead, it's more of a probability range, okay? It's a way of saying we expect that there will be a 68% chance that the stock will end up within a plus or minus of 30% over the next year. Now, that's 68%. Where does that come from? Well, that's going to come from statistics, specifically what's called standard deviation, and we're going to get into that later on when we talk about probable ranges. Don't worry, it sounds more complicated than it is. So to sum it all up, the IV is the market's forward-looking estimate of how volatile a stock might be over the next year, not a guarantee. So taking a look at the bigger picture here, the IV percentage is about the stock, not the option. Okay, so when you go into your trading app and you see IV percentage 30%, 50%, 70%, whatever the case may be, just know that that is for the stock, the underlying stock that you're looking at, not for that option contract itself. All right. Second point here is expected move rather than guarantee. All right. Now, obviously, in the stock market, there are no guarantees, but implied volatility, because it has the word implied in it, it suggests that this is the implied or expected move of that stock based off of option pricing, supply demand, and that is going to be over the course of 1 year. So when you see a stock, let's say it's a 30% IV, that's for the underlying, that's the expected move, not a guarantee, and that's over the course of 1 year. And again, we're going to calculate different ways of translating that IV into monthly, and it has a 68% chance of happening. So that 30% move has a 68% chance of happening. Again, we're going to look at standard deviation, and the probability of all this is going to make a lot more sense when we go through this video. But just know that these are the factors that make up of what you have to understand for IV percentage. When you see that percentage, you have to understand these things first and foremost. All right, let's take a look at a real example. So let's say you have a stock that is trading at $100 and the implied volatility is 30%. Now, what does this mean? Well, it simply means that the market expects that this stock has a 68% chance of staying within a plus or minus this range of 30%. So 30% to the upside would be $130 from a $100 stock. And 30% to the downside would be $70 for that $100 stock, right? So obviously this is a simple calculation using a simple $100 example, but you can take this and apply it to any stock price, and calculate the, in this case, 30% up or down, right? So you take your little calculator out, you go 100 plus 30%, you'll get the top range, minus 30%, you'll get the bottom range, all right? Now remember, this does not mean that the stock will definitely move between these two ranges, okay? Up $30, down $30. It might move just $5 in either direction or $50 moving outside of the expected range. All right, so I like to think of this more like a weather forecast. If the forecast has 70% chance of rain, that doesn't guarantee rain. It just tells you what the odds look like based off of the current information. Now, another key point here is that implied volatility doesn't care about direction. All right, so a 30% IV doesn't mean that the stock will more likely go up rather than down or down rather than up. It just measures how wide the potential swing might be, okay? So in this case, the swing could be down, it could be up, or a combination in between them, right? So perhaps it could go from $100 to $110 and then crash down to $70, all right? In that scenario, this would be within the expected range of a one standard deviation move based off of the implied volatility. So now that we know what implied volatility is, let's talk about how it actually works. So here's the first thing to understand. Implied volatility doesn't come from the stock's past price movement. It actually comes from the options market. Remember, this is a forward-looking estimate, not backwards-looking like historical volatility, right? Historical volatility tells you how much a stock actually moved in the past. Implied volatility, on the other hand, comes from what traders are willing to pay for options right now. So think of it this way. When traders are nervous, let's say, about expected big moves, they are willing to pay more for options. When things are calm in the markets and the expected move is smaller, then they're not willing to pay as much. Now, this battle between buyers bidding up option pricing and sellers deciding how much risk they'll take is what creates implied volatility. Now, in practice, there is some math behind this, okay? So option pricing models like the Black-Scholes model takes into account known factors like stock price, strike price, time to expiration, interest rates, and even dividends. But within these calculations, there is one unknown, and that is volatility. So the model basically says if the option is trading at this price, what level of volatility must the market be assuming? And that's where implied volatility comes from, right? It's implied by the prices people are actually paying for options. Now, here is something very interesting and important to understand. Studies have shown that implied volatility is usually higher than realized volatility. So, in other words, the market tends to overestimate how much movement is coming. Now, a common range is that implied volatility ends up being about 1.1 to 1.4 times higher on average than what actually happens. So, for example, if a stock ends up moving 20% over a year, the implied volatility of what that movement would have estimated might have been 25 or 30%. Okay, so now let's take this concept and apply it to our previous example. So, in our previous example, we had a $100 stock with a 30% estimated implied move. So 70% on the downside, 130 on the upside. But again, this is the estimate, right, based off of the supply and demand of option pricing. Well, let's take a look at what the actual move might have been, all right, if you take a look back. That $100 stock might have moved in the ranges of $80 to the downside and $120 to the upside. So the actual move in this case is more like 20%. But if you take a look back and you look at what the implied volatility of this move would have been based off of the option pricing, you would have seen a higher implied volatility than what the actual volatility was. All right, so implied volatility was 30%, and because it overestimates usually, the actual move was 20%. All right, so that's a very important thing to think about when you're looking at implied volatility when it comes to options. And just know that most of the time, on average, implied volatility is overestimated and the actual move will probably be less. Now let's take a look at a real world scenario to see how implied volatility actually plays out. All right, so imagine that we have two different stocks, and both of them are trading at $100 today. Now, on the surface, they look the same, but here's the difference. One of these companies has earnings announcing tomorrow, let's say, and the other one doesn't. Now, what happens in the option market? Well, traders know that earnings can cause big moves, right? Up or down, but those moves are almost always more than just a typical trading day. Now, because of that, traders start bidding up the price of options on the stock that has earnings. Again, they're willing to pay more because they expect more volatility. So even though the stock hasn't moved yet, the options get more expensive. And when option prices go up, that means that implied volatility goes up as well. Meanwhile, the other stock that was trading for $100 with no earnings doesn't have the same urgency in the option market, right? So there are no big events on the horizon, then traders are not willing to pay for those options as much. Well, if you don't have a lot of traders buying those options, expecting those moves, well, then implied volatility will stay down. Implied volatility rises not because of what the stock has already done, but because of what traders expect might happen, okay? Earnings, news events, product launches, economic data releases, anything that could shake things up will drive demand for options. And if demand for options go up, the IV goes up as well. All right. And this is going to be a very important point to keep in mind when actually going in and making an investment with options, because this might determine the type of option strategy that you might use, but also when to use it and when not to. All right, so far we've been talking about implied volatility on a yearly basis, right? Because implied volatility is always quoted annually. But what if you are looking at options that expire in a month's time, right? Or in a week's time? How do you figure out the expected move in those shorter time frames? Well, the good news is that there is a simple adjustment that you can make. It's a very simple formula that lets you take implied volatility and scale it down by using the square root of time. Now, I know that might sound complicated, but it's really not. So a lot of people, and I thought this as well in the beginning, is you just take the yearly one and you divide it by 12. Not really similar, but here's the formula. So for this example, we're going to go again with the $100 stock example with an IV of 30%. So we take a look at this. The stock is trading at $100, and you know that, the expected move is 30% to the upside or 30% to the downside, but we want to take this and convert it to a month, okay? So maybe we're buying or selling weekly options, and that information is important to us. So we're going to go to this formula. So we're going to take the IV, 30%, right, times the square root of 1 over 12. Okay, so for the month, we're doing 1 month out of the 12 months that there are. So 1 divided by 12, all right, and then the square root of that. And if you do this calculation on your calculator, you're going to get 0.29, all right? So essentially, the equation is 30% times 0.29, and you're going to get an answer of 8.7. Now, this is the percentage amount that this is expected to move within a month. Now, you can do an easy calculation of what this percentage is in dollar terms. Now, again, because we have the $100 stock price, all of these numbers are pretty easy to understand. That's why I'm using them here. So 8.7% is equal to $8.70, right, from the $100. But of course, if this were different, if this was $106, $93, $52, whatever, then you're going to do the same math, but just know that this end result that you get after doing the equation is going to be in percentage terms, and you have to take that percentage terms and then apply it to this. So if this was a $32 stock price, let's say, and then you take the 8.7% and you add it to 32 to get the top range, and you minus 8.7% from the 32 to get the bottom range. All right. And that's how you get a dollar term. And that's how you determine what the range is in dollar terms as far as the stock's concerned. So if we take this 8.7% or $8.70, we can apply it to now the $100 stock example. And now we have a range, an expected range of movement based off of the yearly IV in monthly terms of, on the downside, $91.30. And why is that? Because we subtracted $8.70, right? Or 8.7%. And on the upside, we have a range of monthly range of $108.70, again, because we're adding 8.7% or $8.70 to the stock price, and we get these two ranges. Now, why is it important to understand how to calculate this? Well, the simple reason is that most options don't last for 1 year, right? 1 full year. A lot of traders are buying or selling contracts that expire in a month's time, 2 months' time, 2 weeks' time. So if you're just looking at the yearly implied volatility of, let's say, 30%, that doesn't really help you decide what realistically can happen in the next 20 days, let's say. Now, for option sellers in particular, this adjustment is very important because when you sell an option, you're essentially making a bet that the stock will stay within a certain range by expiration, right? Or not exceeding a certain strike price. Now, knowing that expected move over the shorter time frame helps you figure out things like, are you selling far enough away from that expected move in order to have a high probability of profit? Or is your strike price too close where the stock could easily move and pass that strike price? So by scaling the annual implied volatility down to monthly or weekly, you're taking the market's forecast and lining it up with the exact expiration that you are trading. Now, this obviously will give you a much clearer picture of whether the premium that you're collecting is actually worth the risk. So instead of just saying that, you have an IV of 30% and this just means that the stock is going to move $30 up or down this year, you can be more practical and say, for this month, the expected move is about $9 up or down, right? So is my strike price outside of that range or not, right, when selling options? And when looking at it from this angle, you can have a better edge on your trade, right? A better probability, or at least a better understanding of everything. All right, now let's connect implied volatility to something even more powerful and very important to understand, and that is probability ranges, right? So, again, looking back, when we say a stock has a 30% implied volatility, it's expected to move $30 this year, let's say with the $100 example, $100 stock price example, or around $9 per month. This is not just a random number, okay? It actually represents one standard deviation move, which in statistics, this just means a 68% chance that the stock will finish inside this range by expiration. So, when looking at any move, any potential range of movement based off of implied volatility, just know that that is based off of one standard deviation or a 68% chance of it actually happening, of it staying within this range. Now, coming down here to the standard deviation chart, we can take a look at the probabilities and understand them a little better, all right? So right in the middle here is the $100 stock price. Now, I'm going to use, instead of the $8.70 example here, I'm just rounding up to $9 for this case, all right, just because it was easier to write out and to understand. But we're going to base it off of this example, okay? So just may pretend this is $9 over here, all right? Because it's pretty close to $9. So $100 stock price is right in the middle over here, all right? Now, a one standard deviation, which means that it is a 68% chance of happening, could be either one standard deviation to the left or one standard deviation to the right. All right. Now, these lines represent the standard deviation move. One standard deviation going out to two standard deviations, going out to three standard deviations. All right. Now, one standard deviation move from that $100 can be either to the left or to the right. In other words, stock price could go down to $91, or it could go up to $109, all right? Again, this is based off of the monthly calculation that we did for here, all right? That $100 stock price. So we took an IV of 30%, we calculated it on a monthly basis, rounded up to $9, all right, just to make this example easier, and we can determine that one standard deviation based off of the implied volatility is to the left, 91, to the right, 109. So this range right here. And this range, this orange part, will happen 68% of the time. So there is a 68% chance that the stock will stay within this range for the next month. All right. Again, this is a monthly calculation. Right. If we were to do a yearly calculation, then we could assume that IV 30%, it could go up to $130 or down to $70 68% of the time. Now, going further out, we have a two standard deviation move. And a two standard deviation move, all you have to do is take whatever you're calculating, right? So in this case, we're using 9 for this example and multiply it by 2. So $18, all right, in our case. So $18 to the upside and $18 to the downside. All right. 9 times 2, you have 18. So two standard deviations is 18. On the low end, 82. On the high end, 118. And this will happen 95% of the time. All right. So 95% of the time, the stock with a 30% implied volatility will stay within the range over the next month of $82 and $118. All right. So pretty good chance there. And you can see as I'm explaining this, hopefully, how this fits into your investment, especially when you're selling options, right? So if we go out to three standard deviations on one side or the other, we're going to take 9 times it by 3. So we have 27. So we take 27 off of 100. We have a low end of 73. And we add 27 to 100. And we have 127. And this will happen. This whole range here is 99.7% chance of happening. So 99.7 is the probability that the stock within the next month will stay between $73 and $127. All right. So this gives you a better representation of probability rather than just taking a look at the implied volatility and saying, well, implied volatility is 30%, 50%, 70%, whatever that case may be. Now you can translate it to a actual percentage probability chance that your stock will trade within these ranges. So if I have a $100 stock price and I'm selling options, for example, and maybe I want to sell an option with a strike price of between $100 and $109, well, you might take a look at that and say, well, there's a 68% chance that it's going to trade between this range. So maybe I take my strike price and I put it further out. Okay. And we're going to take a look at what that means for our full strategy later on. But that's just an example here. I don't want the stock to hit my strike price. So I know that I have a 68% chance that it will reach 109. Maybe I go to 110, 111, something like that. All right. So I hope that makes sense when taking a step back and looking at the percentage terms, how that could be used to your advantage, right? Because again, when just looking at the implied volatility of a year, that really doesn't tell you much, okay? It tells you a little bit, but converting it to monthly, putting it on the standard deviation chart, you can see the probability of something happening, and that helps you a lot when trading options, all right? Buying and selling. Okay, so now that we know how implied volatility is calculated and how to use it to estimate expected moves, let's talk about why this actually matters for you as an option trader. So here's the simple version. When implied volatility goes up, option prices go up, okay? And when implied volatility goes down, option prices go down. Now, this is because volatility is one of the biggest inputs for option prices. The more movement that the market expects, the more valuable options become. Now, since options give you the right to buy or sell at a fixed price, big swings means more potential profit. Now, if the market expects calm or boring price action, then options aren't worth as much. All right. This is why you'll often see option premiums skyrocket before big earnings events, right? Traders are buying up all these options, betting on a big move. Demand goes up for those options. IV then rises because the demand goes up, and the premiums themselves, those option contract prices, they go up. Now, let's say right after the event, when the uncertainty is gone, IV collapses and option prices drop sharply. Now, this happens even if the stock doesn't move much. Now, this sharp drop in option pricing is what is called IV crush. And we'll talk about that a little bit more later, right? But there is a basic rule here if you think about it. If you are a buyer of options, you generally want to buy options when implied volatility is low, right? When those premiums are cheap. If you want to sell options and collect premium, you generally want to sell when implied volatility is high and when those premiums are expensive because you'll make more money that way. Understanding this relationship between implied volatility and option pricing is very important because you can be right about the stock's direction and still lose money if you are ignoring volatility itself, because that is a major part of the option pricing. All right, now knowing that high implied volatility makes options expensive and low implied volatility makes them cheap is a good start. But here's the problem. That raw IV number itself doesn't tell you whether it's actually high or low. So let me tell you what I mean by that. So let's say one stock has an implied volatility of 25% and another stock has an implied volatility of 100%, right? At first glance, you might think that the one with the 100% implied volatility is more expensive than the one with the 25% implied volatility, right? You might think 25%, oh, that means cheap, and 100%, that means expensive, but not so fast, all right? This is where it gets interesting. Some stocks are naturally volatile, right? Others are usually calm. So to really know if today's implied volatility, the implied volatility that you're looking at right now, is expensive or cheap for that stock, you have to compare it to its history of implied volatility. And this makes sense, right? If you're showing me right now implied volatility is a certain amount, well, you have to know, compared to the average movement of this stock, is this implied volatility higher or lower than it should be? And this is where something called IV rank comes in. Now, what is IV rank? Well, IV rank measures where today's implied volatility sits compared to the past year of volatility for that stock. All right. So this is again expressed in a percentage term. Let's say you have a stock and you take a look at the IV rank, and that IV rank is 75%. Well, what does that mean? Well, this means that today's implied volatility is higher than it has been 75% of the time in the past year for that stock. In other words, most of the time, IV was lower So right now, it's relatively expensive. Now, if that same stock had an IV rank of, let's say, 20%, this means that today's implied volatility is only higher than 20% of the past year's historical volatility. In other words, most of the time, implied volatility was higher, so right now it is relatively cheap. So let's take a look at an example with two stocks to further understand this point, all right? So you have stock A and stock B. Well, stock A has an implied volatility of 100%, right? Now, you might look at that and think that might be expensive, right? Because 100 is a big number. So you open up your trading app and you go to your options chain and you look at implied volatility and you see 100% and you go, oh, whoa, that's a little high, right? It looks high. But if you take a look at the IV rank of this stock A, it's only at 10%, right? So this essentially means that the implied volatility is actually cheap compared to what it usually trades for, all right? Because 90% of the time, IV would have been higher than it is right now. Now, on the other hand, stock B has an implied volatility of 25%. Again, this does not tell you if it's high or low or cheap or expensive. So it looks low, but it's actually expensive because 90% of the time, the IV percentage of this stock was actually lower, right? Lower than 25%, 90% of the time. Only 10% of the time has it been higher. So this 25% is on the upper range of what the stock's IV is, right? So again, it looks low, right? It looks like it's a low IV, but it's actually expensive if you take a look at the IV rank. So let's take a look at this chart over here to put everything together and understand what you're actually saying when you're taking a look at an IV rank of different amounts, all right? So we have a stock, doesn't matter what the IV is, all right? You're going to look at the IV rank, and if the IV rank is above 70%, well, that current IV is higher than 70% of the past year's implied volatility. Now, if you have an IV rank of between 50% and 70%, well, then the options are still expensive, not as expensive as they were with an IV rank of 70 or more, right? But they're just slightly high at this point. Now, if you have an IV rank of around 50%, then options you can say are fairly valued based off of their historical volatility, right? In other words, if we take a look at this IV of 30% example, implied volatility of 30% with an IV rank of 50 means 50% of the time it's trading higher than 30%, 50% of the time it's trading lower than 30%. So this is a fair value of what the implied volatility usually trades at, all right? Now, 30 to 50%, this is where options become slightly cheaper, right? So options are cheaper slightly when it's 30, 35, 40, 40, 50. At 50%, you're starting to get the fair value, but below that, you're starting to get cheaper option pricing, right? So when you look at that contract and you take a look at, that premium of $2.50, well, then we know that it's cheaper than usual for that option contract, right? And below 30, an IV rank of below 30%, well, options are very cheap because usually they're more expensive. 70% of the time, in this case, they are more expensive. So right now, options are cheap for that example, all right? So understand this. Understand where it looks high, but it's cheap, or looks low, but it's expensive. Don't get confused by just looking at IV percentage, and you'll have a better chance of understanding if your options are expensive or if they are cheap. So now the most natural question is obviously, where do I find IV rank, right? Because on a lot of trading platforms, you don't see IV rank. You take a look at your options and you see IV there, but that's just the IV percentage. And again, that doesn't tell you the full picture. Well, this is a good question, and there's an easy answer for this, right? In most cases, you just Google it, right? Or Chat GPT it, right? It's very, very easy to find the IV rank of a particular stock, and that is part of the sort of research process that you have to do in order to trade options effectively by understanding implied volatility, but linking it together with its IV rank. But again, it's very important to get this info before going into an option trade because you want to understand if the options that you are buying or selling are cheap or expensive. In other words, you don't want to overpay when buying options, right? Paying more than you would otherwise have to. And the same thing goes when selling options, right? If the options are cheap compared to usual, right? Compared to what they're usually trading for, then you might not receive enough premium for your trade to be worth it when selling options. So this is why this rule still holds true, and I'll say it throughout this video. You want to buy options when they are cheap and sell them when they are expensive. This is just another reason for using this rule. Now, one of the most important things to know about implied volatility is that it usually tends to revert to the mean. Now, in other words, IV doesn't stay extremely high or extremely low forever. It usually drifts towards its historical average over time. So here's how it plays out. When IV spikes higher than normal, like before earnings or during a sudden market sell off, it often comes back down once the event passes and uncertainty fades. Now, when IV drops to a very low level, maybe during long, calm rallies where traders aren't worried, well, it usually doesn't stay that quiet forever, right? There's always events coming up and earnings and this and that. That will shake things up in the market and IV will then rise again. Now, this mean reverting nature of volatility is why experienced traders, for example, pay so much attention to IV rank, and you should as well. So a high IV rank doesn't just mean that options are expensive today, it also can suggest that over time, IV is more likely to come back down, which can benefit option sellers because you're selling options, you want to collect the premium, you want a high premium. Well, when is there a high premium? Well, when there's high implied volatility in that stock. Now, a low IV rank means the opposite, right? So if implied volatility has room to go up, from its cheap levels, well, then we probably want to buy options to take advantage of this increase in volatility. So always keep in mind, volatility is event driven in the short term, but over the long term, it tends to settle back towards its average. Now, to better understand this, we have this sort of chart right here of the mean reversion nature of implied volatility, right? The orange dotted line in the middle is going to be your average. Now, sometimes implied volatility is higher than the average, and sometimes it's lower than the average, right? Now, over the long term, this will even out to a more average amount. But if you're taking just short term movements, all right, so if I just block off here, these 2 points, well, then in the short term, it could stay very high, right? Or in the short term, it could stay very low. But more often than not, it will revert back to the mean. So that means when it's up, it'll come down. When it's down, it'll come up, and so on and so forth. All right. So we can take advantage of that because we know if implied volatility is low, then we want to buy options. Why? Because then if it reverts back to the mean, so if it's low and we buy here, and if it reverts back to the mean, well, an increase in implied volatility will mean that your options will increase as well because more implied volatility baked into your option price means a higher option price, right? Same thing on the high side. If you have high implied volatility, so if you're right here where the stock is trading at a certain amount and you look at the implied volatility, you take a look at the IV rank and you consider that, oh, that's higher than usual. Well, then we know that it might very well revert back to the mean. That means implied volatility will drop. Well, then that option contract will lose value, right? And so what do we do if we know that it's more than likely for that option contract to lose value? Well, then we want to sell options and collect a premium and then hope that that option contract falls in value or goes down to zero or close to zero as possible. So again, very important concept when trying to pick strategies. And we're going to go into the whole strategy in just a second, but just know this, take a step back and say, well, it makes sense, right? When implied volatility is low, I want to buy options. When implied volatility is high, I want to look to sell options. So using this as a framework will really help you out in option trading. All right, so far we've talked about what IV is, how it is calculated, and how to measure if it is cheap or expensive. But what actually makes implied volatility change? Why does implied volatility go up or down? So now let's take a look at a few different scenarios of how implied volatility is affected by different things happening with the stock or the overall market. All right. So stock drops suddenly. All right. What happens to implied volatility? Well, implied volatility will go up. Well, why is this? Well, if you have a slow and steady stock, nothing really going on, no fear, right? There's a lot of comfort in that stock movement, and all of a sudden it drops suddenly. Well, what does that sharp drop mean? Well, that means fear has entered the market. And what do traders do? Well, they bid up option prices for protection. increasing the demand for option pricing and therefore increasing the implied volatility, right? So what happens now if a stock moves more than expected, or rather more than the expected range, right? So again, we have an expected range of what a stock can trade in between, right? IV of 30% means $100 stock could go to 70 or 130. But what happens if it jumps up to 160, right, within this time frame or within a month's time frame? All right, we know it could go up to 109, but what if it shoots up to 118, two standard deviations move, rather than the one standard deviation move? Well, that's more than expected. Well, in this case, again, the supply and demand of options will increase the implied volatility. And if the implied volatility goes up, well, this can obviously then potentially affect the option pricing themselves. Implied volatility will also go up if there is a market-wide volatility spike. So not just things that affect specific stocks, but if the market as a whole, implied volatility on the market goes up, then the implied volatility, obviously, of the stocks will go up as well. So now let's take a look at things that cause implied volatility to decrease, to go down. So if the market or a stock rises steadily, right? So just kind of think of this example, all right? It's going, no huge spikes up and down like this. If it's just calm and up, then implied volatility is going to go down, right? Because then the market doesn't expect a move to go outside of the range of one standard deviation. Now, what happens if the stock moves less than expected? Well, that's going to be the opposite of if a stock moves more than expected. If it moves more than expected, IV goes up. If a stock moves less than the expected move that we think it's going to make, IV will go down. Now, this is especially true post earnings. If there is a small move, or rather less than expected, IV will go down, and it will go down dramatically, because think about it. When you have earnings coming up, there is a lot of demand for those options. This causes implied volatility go up because they think the expected move is going to be a high one, right? Higher than usual. Well, if the stock doesn't move to the expected range that people think it will, IV will crush down, IV crush, right? This is where the term comes from. It will come down, and therefore you can lose a lot of value of your option contract this way, all right? With the IV crush, with the IV going down. All right, so now let's put it all together into a clear, repeatable process that you can use every time that you want to enter into a new option position. So the first thing that you're going to want to do is pick a stock, right? Obviously, this is the first thing. You're going to look at the stock market, look at your stocks, and take a look at which one you would be interested in trading or investing in, all right? So once you have your stock, you're going to then check the IV percentage. So now by looking at the IV percentage, what does this tell you? Well, this is going to tell you the market's expectation of how much that stock might move in the future, expressed by a percentage over the course of 1 year. All right. And things to keep in mind when looking at this is, of course, it is about the stock, not the option contract itself. It's the expected move, not a guarantee, over the course of 1 year. And there's a 68% chance that this is going to happen. All right. So 68% of the time, that stock will move within the range of the implied volatility. Then you're going to want to, step number 3, convert to the time frame that you are looking for. So for example, if you are selling options on a monthly time frame, then you're going to want to convert the annual IV, which is where it's at, where you're looking at it, to monthly, just the way we did over here. And of course, if you're looking at weeklies, for example, then you're going to want to do the same thing for weekly. So instead of 1/12, it's 1/52. So now by step number 3, you should be able to determine if the option contracts for that particular stock that you're looking at are expensive or are they cheap. Now, once you've determined that, then you can go ahead and apply a certain strategy to that particular stock in those particular options, right? So again, I've said it many times in this video, match the strategy. Well, how do we match the strategy? Well, we want to buy if implied volatility is low, because we're getting cheap option prices, and our whole idea is for the option contract to go up in value. So it's better if they're cheaper, obviously. And we want to sell if option contracts, or rather the implied volatility is high. That means that option prices are high as well. Then we're going to get a good amount of premium when selling those option contracts, right? And then with everything involved, reverting back to the mean or other events that might take implied volatility down, you can then sell when prices are high, and then buy back your contract when implied volatility is low. That means option prices are lower. You make a profit, you go on with your day, everyone is happy, all right? Now, next step would be to place strikes using expected move. Now, what do I mean by that? Well, there is an expected move that is likely to happen, right? 68% of the chance the stock will move between the range of whatever the implied volatility is, right? So now what does that mean for when buying options? Well, when buying options, we want the stock price to reach the strike price and exceed it, right? So looking at this example over here of this standard deviation curve, you have a $100 stock price, right? Well, we've calculated that it is 68% probable that this stock will stay in the range of 91 to 109, all right? With 109 being the top part of this one standard deviation move. Well, then we want to choose a strike price that is below this amount. You don't want to go higher than 109 because then that will leave the probability of it happening very low. So we want to increase our probability of us making money. So we want to put our strike price below $109. So now we can see how we took a look at the implied volatility. We've calculated the monthly move. Then we're looking at monthly option prices, and we want to now pick a strike price. Well, this is going to help a lot when picking our strike prices. Now, same thing happens when if you want to sell options like I think I talked about this earlier in this video. I want to sell it with a strike price where the stock will not reach or most likely will not reach. So maybe I go higher than 109, $110, right? In this case, then I'm putting the odds in my favor that the stock will not reach that price within the expected move. So we're using our strike prices and we're placing them using the expected move to our advantage. Now, step number 6, check for events. Now, what do I mean by check for events? Well, stay up to date on when earnings are, right? Because earnings can drastically change your option pricing by the demand of the options, implied volatility going down, IV crushing your option prices. So you want to be aware of all of that when you go into the trade. Take a look at the calendar, the events calendar. You can Google this. A lot of trading apps will have when earnings are coming up or product launches or things like that. That will affect implied volatility, right? You want to be aware of this and just keep that in mind because then you can probably even take advantage of it, right? Buying options leading up to earnings events, right? Then selling them right before, right? Because you don't want to get IV crushed. And then the last thing on the list is monitor IV for your exit. Now, what do I mean about monitoring IV? Well, we always want to check the implied volatility and how it has changed relative to what it was, right? So if your implied volatility starting out when you bought an option is 30 and now it's 50, well, then we understand that implied volatility went up, right? But now, is it more expensive or less expensive than it usually is? So if we bought options with implied volatility was, let's say, 30% and now it's 50%, well, now we know that it went up. Well, now we want to check the IV rank and understand if now today's new implied volatility is higher than usual or lower than usual. So understanding where you currently are in the trade is very important, not just when you make the trade, where you're currently at right now. So you're always going to want to monitor that IV. If IV spikes up and your contract goes up, you might sell your options because you know it'll probably revert back down. Knowing when to exit based off of IV and by monitoring IV is a thing that you should be aware of, and that will only help you make profit. And that's the name of the game. Now, once you understand all of this, you can go ahead and apply this knowledge to your favorite option strategies. And one of my favorite option strategies is selling options, collecting that premium, doing that over and over again for passive income, and taking the risk out of option trading. So if you want to learn about selling options, you can click right here for the next video. Other than that, let me know what other videos you want me to do on this channel. Thank you all so much for watching, and we will see you on the next one.